Did you know that 45% of home buyers, 45, regret their home purchase? This particular report was done by, or not report, survey was done by Bankrate, and I was shocked by what I read in this. We're going to go ahead and dive into that. We're going to talk about PPI. We're going to talk about what Tudor Jones said about Bitcoin, gold, and stocks. But before we do that, I have a treat for you this morning. We've got the one and only Sonny here this morning, wanted to say hi. Lots of you ask about my puppies. Sonny is the one that always follows me around, so he wanted to say hi this morning. Hey, buddy. There you go. All right, go back to bed. All right, let's jump into this Bankrate survey. Again, 45% of homeowners regret buying their current home. I don't know about you. When I saw that number, I had to dig in and figure out what the heck is going on. There's a lot in there, but here's the deal. The most common complaint, and this one is frankly frustrating, but here you go. Most common complaint, 45% of homeowners regret buying their home, is frustration over price of maintenance and hidden costs. I was most intrigued by the notion of hidden costs, so I had to keep reading. Apparently, internet bills, property taxes, and maintenance are hidden fees. Really? Did we not know that you would have property taxes? And did you not know that you would have internet and utilities and garbage and water? Really? This is a surprise to you? If this is a surprise to you, maybe you shouldn't buy a home. If you're not stepping up to an adult and understanding what costs to own a home, maybe you are not ready. And certainly, please don't stretch yourself. The people that get in trouble in housing are the ones that take themselves to the maximum purchase price, and then maintenance and hidden fees really add that pressure and can lead to bad outcomes. The last thing I read about this report, again done by Bankrate, you can go find it yourself, I'm sure. The typical homeowner spends $18,000 a year on non-mortgage expense. So again, taxes, maintenance, insurance, all of that. 18 grand. However, if you are in the lovely state of California or Hawaii, you're spending $29,000 on non-mortgage expense, which I thought was pretty wild. That's almost 30 grand. Crazy. All right, let's talk about inflation. We got our second of three readings. Remember, we got CPI yesterday, and it was a clean sweep. All four metrics, month on month, year on year, headline, core, better than expected. You can say pretty much the same thing about PPI this morning. PPI headline came in at 2.6. It was expected to be 2.6. Core came in at 3.0. Expected to be 3.1, so a big beat. Core was expected to rise 0.3 month on month, came in at 0.1. Big beat. And headline came in at 0.1 with expectations of 0.2. So clearly 3 out of 4 beat with 1 matching. And thus far, tariff inflation not coming through. Does this give the Fed pause to maybe have a rate cut sooner? More on that in a minute, because I think the job market is screaming right now, and we'll go into that in a minute. We did see the 10-year note continue to drop. It is now at 4.35 last time I checked. It will be very interesting to see where we go from here as the Fed meets next week. And I believe we get a indication via the SOP, sometimes called the dot plot, what the Fed is thinking. How many rate cuts this year? Where's the unemployment rate go? Inflation, all of that. Lots and lots of stuff. So let's go to the job market. Again, remember, folks, every Thursday we get our drumbeat on weekly unemployment claims, and it's going up. The trend is clear. I believe this is the 4th week in a row we have been above that 220 level that seemed we were baselining forever. Came in at a cycle high, currently at 248. 248. We're knocking on the door of 250. This is not good, not good, not good. However, the real problem, as I've said all year, is not the new unemployment. It's not the unemployment rate. It's continuing claims. And continuing claims is almost going vertical. It is now at 1.95, expectations for 1.91. So what we're having here is duration. This is what I warned about. This is what I feared, is if you did get a notice, it would be tough out there. And yes, continuing claims 1.95. We could very easily be over 2 million next week, if not next week, the week after. It is getting interesting out there. Don't know if you saw this, but I got some updates from Trueflation and GDP Now just to figure out what these up-to-date metrics are. Trueflation is saying that the Fed has done their job. The Fed has done their job, came in at 1.91. Again, if you don't know what Trueflation is, it's kind of updated daily as economic metrics come in. It is the most accurate, up-to-date. I should say it's the most up-to-date and is fairly accurate. Certainly, the closer we get to the end of the quarter, which we are almost there, it has proven that time and time again. GDP Now has had some small adjustments. We peaked over 4% about a week ago. Now still at an impressive 3.8%. That was last updated on June 9th. Let's talk about, let's give shout out to Frank. Frank runs one of our accountability groups inside school. He was, I believe, the first to step up and do that. And he just executed his 50th week of accountability calls. It is such an amazing thing to watch go-givers do that each and every week. Again, we have 7 accountability groups. Frank was the first, leading the way. I want to thank each and everyone who runs a group. And thank you for giving back, being a go-giver, whether it's Ladies of ORaaT, Multifamily, Out of State, or any of the other amazing groups. We did have an IPO, Chime. Chime went out at $27 and an evaluation of 11.6. I think something very interesting is happening. I think the IPO window is opening. What does that mean? Well, frankly, liquidity. There's a lot of companies. I think of Databricks, for example, one of the highest valuations, I think last valued at 60 billion or something. There's going to be a lot more IPOs, which means more liquidity, more money running around in the system. There will be some people getting uber rich via IPOs. And if you're in a tech sector like the Silicon Valley, more and more people with money to do what they do. Oracle came out yesterday with the beat top line, bottom line, and raised guidance specifically for cloud. Their cloud growing. GameStop did something weird, or I don't know. GameStop's trying to be MicroStrategy, near as I can tell. They're doing a convertible note offering, $1.75 billion to potentially buy more Bitcoin. Don't know if you know this, but apparently GameStop bought 4,710 Bitcoin. Are they trying to become the next MicroStrategy and just become a Bitcoin reserve? Who knows? But yes, they're going to raise another almost $2 billion. Pretty crazy. I want to shout out some school members. I failed to do this the last couple of days. I apologize. We had 3 new school members in the last couple of days: Kyle, Johnny, and Sammy. I want to thank each and every one of you for joining. Please introduce yourself. Get all those free goodies by getting to level 2 and level 3. You won't regret it. Have fun and enjoy the amazing group. Scott Bessent is floating an idea to extend tariffs. Remember, folks, the 90-day tariffs on the rest of world ex-China is supposed to end, I think, on July 9th. Bessent floats the idea of extending tariffs in good faith as trade talks continue. This makes, just more and more sense. Again, folks, remember, I've said all year, I actually said on January 20th to buckle up. The first 6 months will be chaotic. July 20th is almost here. We're, 5 weeks, 6 weeks away. So again, I think, the uncertainty is getting better and better, and extending the tariffs in good faith is just another sign that we are headed to less uncertainty, in my opinion. Let's talk about Paul Tudor Jones. Paul Tudor Jones was on Bloomberg talking about how to escape the debt trap. And now by the debt trap, of course, he is referring to the U.S. debt, 38 trillion or whatever it is here currently. Basically, what Paul Tudor Jones is saying is buckle up. It's about to get wild. Paul Tudor Jones starts off by saying, we need a dovish Fed chair. So Powell is gone. Insert puppet. Dovish Fed. That will lead to negative. This is just negative real rates. Yes, folks, negative real rates when adjusted for inflation. Short-term rates will be at about 2.5%, long-term 3.5%. The dollar is going to fall another 10%. We have to run the economy hot and grow your way out. Again, Paul Tudor Jones, obviously a legend on Wall Street, recommends Bitcoin, gold, and stocks as the way to hedge what he sees coming. So I just want to play this out again. If you have long-term rates at 3.5%, we'll just call the 10-year at 3.5%. Let's throw on 200 basis points, even 2.25. That will get you a 30-year mortgage rate with a 5 handle, somewhere between 5.5 and 5.75. And guess what happens then? Wild to think about. Well, that's what Paul Tudor Jones says. How do we escape this $38 trillion is inflate our way out and depreciate the dollar. If you want to say it a different way, folks, own assets, especially if the assets have 30-year fixed rate debt. Pretty wild to think about. Redfin made an update that is interesting to look at. 14% of all transactions were canceled in April. Buyers are uncertain. Buyers are afraid for their job. 14% of transactions, according to Redfin, equal 56,000 cancellations. Again, remember, folks, you list a property goes pending. You have this duration where you can cancel. Again, 14% of transactions canceled. That is a cycle high for the last couple of years. Buyers were basically afraid of tariffs, afraid of a recession, and afraid of job losses. So an interesting report highlighting the top and bottom, right? The top 3, the bottom 3 was actually the top 10 and the bottom 10. I just took the top 3 and the bottom 3 markets for the highest and lowest appreciation, Q1 of 2020 to Q1 of 2025. We'll go to the lowest first. All 3 of these are in the state of Louisiana. In fact, if you looked at the bottom 10, I think 7 of the 10 were in Louisiana. If you invest in Louisiana, let me know. I've never done any research there. Let me know what's going on. But New Orleans came in at number 3 at 20.7%. So again, that is on the low list. Alexandria, 20.7%. And the least appreciating market is Lake Charles. Lake Charles, Louisiana, 16.7%. Wasn't Lake Charles where Grant Cardone's from? Do I remember him saying that? He's always from Lake Charles, Lake Charles, Lake Charles? I don't know. Anyways, Lake Charles had the worst 5-year appreciation at 16.7. All right, now to the best. I would have gotten one of these right. I would have guessed, if I guessed 3 times, I would have gotten one of these right, and it would have been number 3. Number 3, top appreciating market is Knoxville, Tennessee. Knoxville, Tennessee at 87.4%. Next up, Pinehurst, North Carolina, 88%. Wild, almost a double. And then finally, Hinesville, Georgia. It said Hinesville, but is it Huntsville? I don't know. I think, is there a city called Hinesville? Apparently there is. 90.1%. 90%. That's a double. That's nearly a double if you bought in 2020. Pretty crazy. Last thing, I guess maybe 2 more things. We'll talk about Jamie Dimon, and I have something on Grant. We'll do that as well. Jamie Dimon, out in the news media, trying to stir up noise again, warns that the U.S. economy could soon deteriorate in the coming months, basically warning that the summer is going to be choppy, if not weakening. And then finally, Grant Cardone, saw him all over my X feed, saying that Jerome Powell has done more damage to the middle class than any other Fed chair, which I think is something you can argue. But what he says next is absolutely true. He blames the Fed for the housing crisis. I agree with that 1,000%. The Fed shattered the housing market. They have nuked any move-up buyers, and we are seeing record low transactions each and every year of the last 4 years. So again, folks, a lot of stuff going on. Remember, sign up for school, 67 pennies a day. You're going to get the ability 8 a.m. on Sunday to interact with Mr. Dan Bird, who has made a lot of tremendous stock market calls the last several years. Got a 3, 4, 5 year playlist if you want to go back and listen. Bring your stocks, bring your portfolio. He will be there asking questions or answering questions. So again, folks, don't forget to sign up for school now so that you can partake in our Sunday conversation. And of course, don't forget the Zuber Letter. Zuber Letter is quickly growing. It is a collaboration between Resi Club and myself that we take one of our videos each week and go a little bit deeper. Let me know what you think. Zuberletter.com is free. Just another way to give back to the community. Take care, have fun, and of course, go check out Steadily Landlord Insurance. They have helped me save thousands of dollars and get better coverage. Maybe they can help you, maybe they can't, but you never know until you give them a chance. Link in the description. Later.